Alright, so today, that professor that had the life insurance policy, or not life insurance, but started at his kids' IRA. Today we were going to have a life finances class, so I wanted to make a video and just kind of cover most of the parts. So there was really 4 sections that we were going to talk to, but we only really covered 3. So the 4 are retirement planning, like intelligent retirement planning, mortgages, the math behind mortgages and what's the best option, credit scores, and then order of operations, the way things should get done. We didn't really get to order of operations, but I think we're going to continue. I may make another video about it. I may just add it in the description or something. But so we started off with credit scores. So credit scores are your personal credit. It's the way he explained it. In financial services, there are somebody rates the investment vehicles or investment options out there. So there are AAA bonds, AA bonds, and stuff along those lines. And the ratings really come from the numbers behind all the specific. I believe it's something along those lines. I don't remember it too much. But your personal credit score is kind of the numbers behind your finances, and then they'll give you a credit score, which is kind of your rating. Some people are going to have very high credit scores, so they're going to be like the AAA bonds for other people to give credit to, lend money to. And then some people are going to be, like on the movie The Big Short, there was like double B bonds or house mortgages or something along those lines. But so someone with a lower credit score is gonna have a harder time receiving loans, and if they do get a loan, it's gonna be at a kind of higher interest rate. So it's always in your best interest to have a good credit score. Everyone by law is allowed to check their credit score once a year. And the website to get your free credit score annually is called annualcreditreport.com. And so there's 3 companies that actually keep an independent record of your credit. It's Experian, TransUnion, and Equifax. Those are the 3 companies that keep a record of your credit score. A slang, if you're in the finance world, FICO. FICO is a slang term for someone's credit score. So the credit scores are anywhere from 850, which is the highest, 700, which is decent, pretty good. 500 is relatively bad, and then 300 is garbage. But your credit is really determined by payment history of phone bills, rent, student loans, how long you've had accounts for. They're all things that come together, and they're all weighted differently, but that in total comes together and gives you your credit score. The best advice that he could give us, other than like make sure that your credit is good, and if it's not, take a couple years, really focus on it, and slowly put in the systems that you need to make it improve over time, so you can get better home mortgage loans, better business loans, better car loans, stuff along those lines, because it's not necessarily free money, but it's cheaper money than if you were to have bad credit. And the one advice that he told us is co-sign your kids' credit card earlier so their interest is low and they can start learning about money and stuff along those lines. So then after credit scores, we went into credit scores. The next thing we went into was mortgages, and mortgages was really interesting. So in class, he made us raise our right hand. I will never, ever, ever, ever buy a 30-year mortgage. So first thing right off the bat is do not buy a 30-year mortgage. We did the math for it, and say you're buying a good home at $25,000 or $250,000. The interest is say 6% yearly. It's a 30-year mortgage. So how much are going to be your payments? So you do the present value calculation to figure out what the present payments are going to be, and it's going to come out to be roughly $1,500. For 30 years, you're going to have to make monthly payments So it's going to be 360 payments. So if you multiply that 1,500 by 360, you get somewhere in the ballpark of $540,000. $540,000 is the total amount you're going to pay over 30 years to trying to buy a $250,000 house. So when you subtract the $250,000 house, you're actually paying 289, close to $300,000 of pure interest. So he says, do not get a 30-year mortgage, because you're going to pay more interest to the bank for letting you borrow that money than you would in even buying the house. So he recommends buy a fixed rate 15-year loan. And when the math behind it, so 15 times 12, because monthly payments, you're going to make 180 payments. Makes sense, which is half of the 360 for the 30-year loan. It's the same value house, $250,000. So you multiply, you do the math, 6% interest, you do the math, and it's roughly a payment of $2,100. Although it is like $600 more a month per payment, when you do all the math, you multiply it by 180, it's close to $380,000, $380,000 compared to the $540,000. When you subtract the payment from both, the 15-year mortgage, you're only really paying $130,000 of interest, while the 30-year mortgage, you're paying $290,000 for interest. So that's $160,000 difference that you're not paying the bank. You're paying the house off equally, but you're not giving an extra $160,000 to the bank. So that alone, he says, if you make one decision from your entire college experience, and it's to get a fixed rate 15-year mortgage, you basically paid off your college education and more by making that decision. Although it is going to be, you are going to have to make sure that you scrap and are able to make the payment every month, because it is going to be higher. But in the long run, in 15 years, you'll save yourself $160,000, which that's a lot of money. So to become a qualified buyer, he mentioned a couple of things. So for somebody to give you a really good loan, for a mortgage loan, you need to be considered a qualified buyer. And to be a qualified buyer, there's two things that come into play. Your principal of the payment of your house, plus the interest, plus the taxes, plus the insurance of it, all need to come together as a number. They refer to it as PITA, or PITI. Needs to be less than 25% of your monthly income. So the biggest rule when it comes to mortgages, don't buy a house you can't afford, because you may not be a qualified buyer, and if you do, you're going to be stressing a lot to make the payments continuously, and the rest of your life is going to be a lot lower value, quality of life. So make sure that you get a house that you can afford. If not, just rent for a while you save. But your PITI, principal, interest, taxes, and insurance, needs to be less than 25% of your monthly income. And then additionally, the second point is all debt payments need to be less than 33%, which includes your student loans and your credit card debt and the principal house mortgage payment. So those two things will allow you to become a qualified buyer, which gets you a very good rate on your home and stuff along those lines. The two things he told us never to do is never get a 30-year mortgage or an adjustable rate mortgage. Because with adjustable rate, if insurance or interest rates go up, they will then change your interest rate. So although we have a 6% yearly a year interest rate, if it goes up to 10, now you're going to be paying close to $300,000, $350,000 of pure interest, not going into what you're paying for the house. So those were mortgages. Get a fixed rate 15-year loan, and then do not buy a house without title insurance. Title insurance ensures that if somehow the deed or something along the lines, there's been a mistake or somebody didn't really hand it over, something, if there's any trouble, you don't get, it's still your house. He said the last thing you want to do is buy a house, be paying for it year after year after year, and then come to find out you never had a title. So get a fixed rate 15-year loan, do not buy a house without title insurance. So it was mortgages. And then the last thing we really went into, which it was retirement. So most of us in the class are 21. So we wrote down age 21. Then we wrote down the age we would like to retire. So we put 65. So that's 44 years of a working career. 44 years. And then death, approximately, the example we used was 85. So then our retirement was supposed to last us for 20 years. Because we're taking the security class, portfolio management, he asked us what percent return we could expect to get throughout our working life, and we said 10% throughout our working life. So for 44 years, we believe we can get on average an annual 10% increase in our portfolio. Once we retired, we don't really want to grow it so much. We really wanted just to kind of be more stable, so we went down to 6%, and mostly because inflation is 3%. So those are the numbers just beforehand to really give us an idea of how much we're going to be needing once we retire. So then the math comes in, and the math starts off with how much are you going to want to get yearly from your investments once you retire at the age of 65 to 85. We said $50,000 because our house would be paid off, our kids are already grown, our kids would most likely already have college funds and stuff along those lines. So $50,000 to eat, travel, stuff along those lines. So we do the math, and in total, we needed to get the present value for the present value of, or the future value of $50,000 in 44 years is going to be roughly $183,000. We do the math to figure out how much we're actually going to need in total to get that amount every year, and the math came out to be 2.6 million roughly dollars at the age of 65 in our portfolios to be able to give us $50,000 every year. So to have $2.6 million, what we would need in our portfolios today to grow at a 10% every year until we retire at 65 for 44 years would be $40,000. Now none of us really have $40,000, so we actually have to figure out to build that $40,000 within year by year, how much would we have to invest every year into our Roth IRAs, our IRAs, or 401k plans to be able to get to that number. So we did the present value of the $40,000 to figure out how much it is that we actually need, and every year after taxes have been taken out, we should be saving or putting away $4,096. So roughly $4,100 we should be putting away every year after taxes to be able to save up enough to be able to retire at 65 and still make $50,000 every year, with the assumption that we can get 10% return on our portfolios through our investments every year to grow to 2.6 million. The way you can save that, or the way you can invest it, there are two options. There's the IRA and the 401k. The IRA has a limit of $5,500 every year that you can put in, and then the 401k has an $18,500 limit. Now, some companies have a matching policy, so the number can be higher than that, but you personally can only put in $5,500 for the IRA, $18,500 for the 401k, and those are tax advantages, so that's the way you want your money to grow. Throughout all the math, it doesn't seem that difficult to understand that you have to keep putting away year by year $4,100. If you divide that by 12, that's roughly $350 a month. Of course, some of us don't really have that right now, but hopefully with the more we learn, the more we're able to talk about business, the more we're able to add value to businesses or organizations that we work for. They'll promote us, they'll give us better pay, better packages and stuff along those lines. But by being able to put aside $350 a month, or even more than that, we'll ensure that you'll have money when you retire in case anything ever happens to Social Security, something along those lines. But also we could, what he did is he started it for his kids, so he was able to put money away in their IRAs when they were really young. So this was kind of the retirement planning thing. And then we were running out of class, we were running out of time in class, but he started the order of operations. So the things we need to get done first, really only talked about one thing, and it was no credit card debt. Credit card, the interest on those things were like 21%, 25%. So having credit card debt, you're paying close to interest every single time. So to pay down the principal, you have to pay so much more just to make sure that you don't have credit card debt. So just not having credit card debt in the first place is a great start. And then I was looking through the library, and there was a book that I had that really kind of talked about this stuff if someone else wants to do further research or something along those lines. The title was really cheesy, but I Will Teach You to Be Rich by Ramit Sethi. Some of the chapters which go into some of the stuff we were talking about in class. Optimize your credit card, beat the banks, get ready to invest, conscious spending, save while you sleep, the myth of financial expertise, investing isn't only for rich people, easy maintenance, and then a rich life. So this book I know goes into credit scores, how to build good credit, getting good credit cards with good interest rates, but also good benefits, wedding planning, mortgage planning, planning for a marriage. So I know this is another book that I have in the library, but if somebody wants to check it out for themselves or something along those lines. He also has a website that is pretty helpful. But that was the life finance, career finances stuff along the line, around that area that we were talking about in class. I said I was going to make a video about it. We're still going to have another class, I think, that he goes over a couple more things, but I wanted to get this video done, so, alright.